I'm Craig Popp, and this is Charts That Matter. One of my favorite sayings is that the best investors are optimists. Unfortunately, the idea that the glass is always half empty perfectly captures how many investors feel about the economy and financial markets, especially over the past few years. During recessions and bear markets, investors worry that the situation will never improve. When the economy and markets do recover, investors worry that it won't last. In both cases, investors often find it difficult to stick to their long-term financial plans, regardless of the historical record. In today's strong market environment, how can investors stay focused and invested? The stock market has achieved several new all-time highs this year, following last year's bull market recovery. The S&P 500 is now about 2% above its previous peak from early 2022. While this is positive for investors, it's natural to also wonder whether the markets have run up too far, too fast. After all, it was less than a year ago when many investors and economists were predicting a recession and worrying about the rapid pace of Fed hikes. In this context, there are three important facts to keep in mind. First, it's important to understand that it is not unusual for the market to reach new highs during a bull market. Since markets trend upwards over long periods, bull markets spend much of their time at new record highs. The accompanying chart shows how frequently these occur during market cycles. From 2013, when the S&P recovered from the 2008 financial crisis, to 2021, the average year experienced 38 days closing at new all-time highs, or roughly 15% of all trading days. Years such as 2017 and 2021 experienced many more. Thus, new all-time highs are not, on their own, reasons to be worried about the market or signal that the market is about to reverse. Second, what matters is not the level of the market, but the business cycle and underlying trends. While there is still much uncertainty today due to inflation and the timing and size of Fed rate cuts, market sentiment has improved due to steady economic growth. This has driven rallies in technology-related sectors, including across the so-called Magnificent Seven stocks, as well as in areas such as industrials, financials, and healthcare. Finally, while it's natural for investors to feel that they should wait for a market pullback before investing new cash or returning to the market, history shows that this can often backfire. The chart measures the opportunity cost of being out of the market and waiting for a better price compared to simply staying invested. Waiting for a 3% pullback, for instance, has required being out of the market for 69 days on average across history. Over that period, the market rose much more than 3%, resulting in a missed opportunity of a 2.3% gain. In other words, it would have been better to simply have stayed invested in the market the whole time. Waiting for a 5% pullback requires 291 days and results in a missed opportunity of over 13%. Similarly, waiting for 10% market corrections or 20% bear market crashes can take years. In all cases, the peace of mind that comes from sticking to a plan rather than trying to time the market perfectly is an added benefit. Unfortunately, Doing so requires battling our own tendency to see the glass as half empty when markets are rallying. Of course, none of that is to say that the market only moves up in a straight line during bull markets. Investors should always be prepared for market swings and unexpected events, as the past few years have demonstrated. However, it does suggest that it's often better to avoid making rash decisions based on news headlines and the level of the markets, and focus instead on sticking to a well-constructed portfolio, ideally with the guidance of a trusted advisor. To conclude, the market has achieved several new all-time highs this year due to steady economic growth. Investors should continue to stay focused and invested and not make decisions based upon the level of major market indices alone. And remember, in investing, the rear view mirror is always clearer than the windshield.